Good morning. It's Jeffrey Christian, CPM Group. It's 10 o'clock in New York here on the 16th of May. This is our briefing for the 2023 Silver Yearbook, which is being released today. For me personally, this is the 44th year that I've done one of these annual Silver Yearbooks. I started in 1980 at J. Aron, and we had a J. Aron Silver Review and statistics report. We're thinking about changing the title ultimately to go back to Review and Outlook. But right now it's the yearbook with the subtitle Review and Outlook. But yeah, I've been doing this for 44 years, and J. Aron had been doing it probably for a decade before me. So these things have been around for a long time. We do a lot of basic research on precious metals and other metals, and we develop estimates of supply and demand across the commodities, but especially true in precious metals. There's a lot of information on mine production because mining companies have regulatory obligations if they're public companies to provide that data. And they have an economic incentive because they want investors to invest in their companies. Secondary recovery from refiners, fabrication demand, investment sales, and investment buying by the sell and the buy side of the market. None of that is regulatorily obligated to report in any country, and there is an economic disincentive for reporting. So these are very secretive markets, and that lends themselves to misinformation floating around and stuff. CPM Group, and before us, J. Aron Goldman Sachs, was one of two companies that has really delved in and developed a network of contacts around the country, around the world, that allows us to develop reasonable supply and demand numbers as research people, as opposed to sell-side marketing people. We produce a tremendous amount of research on a year-round basis. But once a year, we come out with Gold Yearbook, Silver Yearbook, and Platinum Yearbook, and we bring in sponsors to help underwrite these. These reports get sold for $160 to investors and other people around the world, and this sponsorship program helps us. We have a number of sponsors this year, and I do want to go through them all. Several of them are new. Several of them have been sponsors for 10, 15, 20 years. The Bulgarian Mint's the top one. They are a major producer of refined silver, gold, and platinum group metals. They are a major producer of blanks that are used by mints, both private and public mints. And they're a major producer of medallions and small investment bars, which are really sold around the world. Endeavor Silver Corp, great mining company. Fortuna, Gatos, again, great mining companies. Gold and Silver Vault and Idaho Armored Vault, part of a network of companies that provide investment advisory services, investment management services, precious metals, purchases, sales, and vaulting services in the northwest part of the United States. ISRI, the Institute of Scrap Recycling Industries, been our sponsor since we started taking sponsors in 1995, 1996. Kitco Metals, I think everyone knows, has a great refiner, as well as its Kitco Media source of a tremendous amount of information. Corlin Economics Report, a great provider of research and analysis on precious metals and other markets and the broader economic environment. Metallic Minerals Corp, part of the Metallic group of companies that are exploring and developing, in this case, silver, but they also have gold, platinum, and copper mining companies that they're looking at. Modex Precious Metals, one of the major providers of precious metals investment on a retail level in the United States. Cinda Silver, Mexican mining company that has been around for a couple of years and is doing very well. Pan American Silver Corp, has been around for a few decades, has been a sponsor of ours for many years, as well as a client. Profit Plus Capital Management is part of that same group that is Idaho Armored Vault. Reyna Silver Corp, an emerging silver mining company, new client. Rule Classroom. Rick Rule has retired from Sprott. He has set up Rule Investment Media, and Rule Classroom is one of the services that he's providing, developing a network of programs related to educating investors. So he's stepped away from the sell side. He's still a very large buy side investor. We have participated in a couple of his boot camps, which are very intense Saturday events that go from 8 a.m. until about 5 p.m. Pacific time. We did one in the first quarter on energy metals and battery metals, and we did one on silver in April. Sabin Metals Group has been a sponsor of ours for decades, a major refiner of precious metals, primarily platinum group metals, from spent catalysts, petroleum catalysts, chemical catalysts, but other metals as well. Southern Silver Exploration Company, Silver Mining Exploration Company, Sunshine Silver Mining and Refining Corporation, along with Cinda and Gato Silver, is a part of the Electrum Group. That's Thomas Kaplan's company, the Electrum Group, and these are three of the companies that are in their portfolio. We've known Thomas since 1993 when he got involved in the silver market for the first time. We consider him a great friend personally as well as on a corporate level, and he has been our client, I think, all along through various permutations, most often as the Electrum Group of companies. And Thomas, you may remember, a few years ago produced a preface on CPM Group for our Silver Yearbook. And he did that on an unsolicited basis. He just simply one Saturday said, "Hey, Jeff, can I do this?" And I said, "Absolutely." China partner, we have Shanghai Huatong Silver Exchange. This is a physical exchange for silver and platinum group metals. This is where a lot of the, well, I think virtually all of the silver and platinum group metals that's physically traded within China will go through the Shanghai Huatong Silver Exchange, the same way the Shanghai Gold Exchange does, handles the physical gold flows. So a wide range of clients, sponsors around the world and partners. And we try to do that because we don't want to be seen as a promotional agency for the mining industry or for the retail brokers. We try to cover all sides of the markets. Our client base definitely does. In addition to all those sponsors, we have media partners and distributors. Glacier Publishing, which publishes the Northern Miner and has various other things, including EduMines that they're working on. Kitco Metals again, Kitco Media as part of the Kitco Group. Metals Daily, Proactive Investors, and Prospector News. On the distributor side, these are not media partners, but they're not sponsors, but they help distribute and promote the existence of our yearbooks. CGS Events is a company run by Paul Harris. They have been doing some seminars on copper and gold in the past, and they are working now on organizing a silver seminar for the first quarter of 2024 in Puerto Vallarta. CPM Group is working with them. We'll be there, we'll be making presentation, and we're also suggesting some other companies that might be interesting speakers for the mining industry and the mining investment community. Gold Blocks, Gold Silver, and down below Southeast Asia Consulting. These are companies based in Singapore that provide precious metals and other investment products and services to investors. Intro-Act helps distribute our research to institutional investors and high net worth individuals. Prospector News is part of Prospector News. It's on the media partner side. We've got it over here. The David Lynn Report, which has just begun. David had been one of the interviewers and journalists that worked on Kitco Media. he spun off and he set up his own interview program that's internet-based. And Fortel Private Limited, which is the publisher of Bullion Bulletin in India and organizes the Indian Gold Conference every year and provides other information services within India. So a wide range of distributors, media partners, sponsors, and partners. Let's get into it. And as usual, I'll talk a little bit up front about the market and the prices. I will kick it over to my colleague and partner, Rohit Savant, who is the main author of our yearbooks and our precious metals research in general. Carlos Sanchez and I help him out as needed and as possible. He will go through silver investment demand, supply, fabrication demand, and kick it back to me to talk a little bit about our outlook for supply, demand, and price in 2023. In 2022, the price of silver averaged $21.82. It was off about 13% or $3.46 from the average price in 2021, but it was still the fifth highest annual average price. And the price over the course of the year rose, fell, and then rose again. At the end of 2022, the price of silver was 3.3% higher than it had been at the end of 2021. But you can see in the first quarter, the price of silver rose very sharply. It got up to $27 and some odd cents. Let me see just here, 27. No, it doesn't quite matter what the price was. It then fell through from early March through April into September, and it got down to $17. That was lower than we thought it would happen. The price, we had expected the price to fall, but going down to $17 was perhaps greater decline than we had thought. After September, bargain hunting came back in, and the price rose back up to more than $24 by the end of the year. It was kind of traded sideways in December and January, came off in February, rose in March with the banking problems in the United States and Switzerland. And it's been consolidating basically between 23.70, 23.50 on the low side and a little over 26. It's about $24 today. And it's interesting because CPM Group's view is that the price of silver may average around 24.42 this year. That gives you an idea that we think that the price could be weaker in the second and third quarters once more, and then rise later in the year as political, economic, and financial issues start rekindling investment demand. Investment demand, as Rohit will talk about, has been the key driver here. You saw strong investment demand in the first quarter. There was concerns about inflation. There were concerns about will the Fed start raising interest rates and throw the country, if not the world, into a recession? And then there was the Russian invasion of Ukraine. All of that caused investors to buy more silver, taking it from $22 to about $27. March, you saw the Russian invasion actually start, and you saw the interest rate increases at the Fed actually begin too. The world did not go into a recession because of the rise in interest rates, but you saw investors back away. There also continued to be something that we had seen in 2021, which was investor disenchantment on silver. There were any number of investors who had bought silver in 2020, earlier in 2021, listening to people who were talking about $50 or $100 or $750 silver. And when that didn't happen, and the stock market came off 20, 30%, but it didn't come off 90% the way the same people were talking, you saw investors move away from silver. And so in the second and third quarters, you saw weaker demand for silver from investors. You saw some investors selling, and that led to that weaker prices. Once the price got down to around $18, $20, you started to see bargain hunting buying, and you started seeing people saying, okay, this is a good price for the price of silver. That's really sort of where we are. I just run through this, so I won't bother and bore you with it again. And this is a chart I want to show you, which is the long-term price of silver. It goes back to 1975, and you can see there have been three big spikes higher. 1979 into January 1980, the price went from around $5 an ounce up to $50, almost $50 on an intraday basis. On a monthly basis, it got to about $36, I believe, in February of 1980. And then it came down with a thud. It was $16 by April, and the annual average price was about $20 in 1980. We went through a long period of very low prices, $3.50 to $5.50, basically from 1990 into 2004. The price started rising again. Economic issues started coming along, and it got up to almost $50, like $49.95 on an intraday basis, and about $46 on a monthly average basis in April of 2011. And then it came down, not as fast and as rapidly as in 1980, but by 2012, by late 2012, the price was trading around $20. Came down and it moved sideways for several years. And then we started to see a spike up again in 2020, second half of 2020, beginning of 2021. The important thing that I want to make is look at the history of silver prices. When prices can spike, they can spike very high, but they probably can't stay at those peaks. So when you see the price of silver spiking higher, don't think, oh, it's going to 50 and it's going to stay there, because it never has. And it never has because of the fundamentals of the market. Mine production increases, secondary recovery increases, fabrication demand decreases, and investors say, hey, I bought that silver at $5 or $10 or $15, $40, $50. This is a good place for me to take profits, knowing that historically I can buy the silver back at a fraction of that price within a few months. So I wanted to emphasize that because it's a very important thing. And one of the things that we're doing, talking with our mining companies as well as our investor clients, is talking about what are you going to do to capitalize your profits if CPM Group is right and the silver price spikes higher, as we expect over the next 3 to 4 years between now and 2026. If the price of silver spikes higher, as well as the price of gold, what are you going to do to capitalize your gains? Are you going to sit there and say, gee, I'm right and I'm rich, and then watch the price fall back? Are you going to sell out your assets and hope that the price falls back? Or are you going to keep your assets and find a way to hedge it? Futures, forwards, options, or some other strategy. And we're talking a lot to our investment clients, institutional and high net worth individual clients, family offices, as well as our mining clients, about what to do now to prepare to capitalize on a sharp increase in the price that could prove temporary over the next 2 or 3 years. Gold silver ratio, we don't follow it. We don't think it tells us much about the future. What it tells about us is the historical range of relative value. You know, it got down as low as 16 to 1 the day that the Hunts went bust in 1980. It's gotten up to about 112 in the last couple of years. And, you know, it spent most of the last half century between 40 and 80. That's a wide range. There are people who pay attention to it. There are people who trade it. We don't advise people to do that, but because it is a topic in the market, we report it. And this chart and some discussion of it is in the Silver Yearbook. We asked in promoting this briefing, we said you can send in questions. And we got 69 questions as of yesterday. And one of them said, can anyone predict the silver market moves? And these are our intermediate term buy and sell recommendations since we started keeping track of them in December of 1980. And in December of 1980, the price was around $16. It had touched $50 11 months earlier. And when we started doing this and somebody said, what do you think, buy or sell? We said sell. And from 1980 through 2000, we were basically going back and forth, buy, sell, buy, sell. And you can see here, we pretty much had a pretty good track record of calling the direction of the market over that 20-year period. And about 68% of the time we were telling people you should, if you're an intermediate term investor, not a short-term investor and not a long-term stacker, if you're an intermediate investor, you probably should be short silver rather than long. And we've helped investor clients and others make a lot of money trading the market back and forth. In November of 2000, we issued a buy recommendation. The price of silver was about $5 at the time. And we didn't issue a sell recommendation until April of 2011. At the top of the market, we said, okay, sell. And then we issued a buy recommendation around 2019 after the market had consolidated for a long period of time. So to answer that question, I don't know about other people, but some people seem to have a pretty good idea of predicting the silver market moves, at least on a longer term or intermediate term basis. And those people are CPM Group. And these projections are not based on any conspiracies, either conspiracies that we believe or conspiracies that we participate in. These are based on our supply and demand analysis and our macroeconomic analysis. We take a macroeconomic top-down view, what's the state of the world and what's it mean to investors? And we take a microeconomic, what's the real market for silver? Mine production, secondary recovery, fabrication demand, investment demand. Not what the marketing hypesters say, what's really going on. We put those together and we come up with these views. So yes, people can predict the silver market relatively well in broad terms, but what they have to do is get rid of all of their beliefs and preconceived notions about what silver really is. Silver market is amply supplied. There has not been a deficit over the past 4 years. If you want to see evidence of that, look at the price of silver. Look at the price of silver not only on a longer term basis, but just last year. Saw strong investment demand in the first quarter. We saw weak investment demand in the second and third quarters. We measure supply and demand as Commodities 101 suggests, which is total supply less fabrication demand. We don't throw investment demand in there so that we can say there's a deficit. We look at the fundamental market, the primary market, people who are buying silver because they need it to manufacture their products, not people who are buying silver, keeping it in readily resaleable form, bullion or bullion coins, and selling it when they see a profit opportunity or they need the cash. Newly refined silver has been more than fabrication demand for 17 years. And during that 17-year period of time, measured properly, during that 17 years, we've seen 2 gigantic spikes in the silver price. In 2005 to 2011, and then again from 2019 into 2021-22. Okay. That's because these surpluses are net additions to investment holdings. Investors are buying increased volumes of silver, 150, 190 million ounces in some years over the last 17 years, and they're bidding the price of silver up. That's what you want from your basic analysis. If you're doing analysis as opposed to sales, you want to look at this primary supply demand balance, because this is going to tell you if the market's tight and it's going to rise or not. So there's plenty of silver coming in on a newly refined basis to meet fabrication demand. And if investors want more than 50 million ounces or so, they're going to bid the price up. And if they want less, the price is going to decline. And that's what we saw last year. We haven't seen 200, 300, 500 million ounces of silver bought by investors. We've seen a lot on a gross basis, and then we've also seen a lot of gross selling. And it's very interesting because one of the things that you'll find around the world is that some retailers are very good at pricing their sales of metal, and others are very good at pricing their repurchases of metal from investors. And investors know that. Many investors know that. So they'll buy from this guy because he has a better price, but they'll sell to this guy because he has a better price when you're selling. And we saw that last year, and we saw it in 2021. So ample supplies on this, and Rohit will touch on it more. And there's also 5.6 billion ounces of silver above ground in either refined bullion bar form or refined coinage form. And about 2.3 billion of that is in the coins. That's this green part. You also have about another billion down below, which is the ETFs. Those are reported. And then on an unreported basis, there's probably another couple billion ounces, half of which is actually working inventories that constantly flow into fabricators and then flow out as finished products. A lot of silver around. We saw last year a sharp decline in silver inventories in London. They only started reporting silver inventories in 2016, 950 million ounces, got up to about 1.17, 1.18 billion ounces in 2021, early 2021, and then it came down sharply. In New York market, which ranges from Delaware to Connecticut, Massachusetts, southern Massachusetts, you saw a sharp increase in from after 2017, peaking in 2021 and coming off sharply. Market's not running out of silver, and these are not particularly worrisomely low levels because that silver has gone to other places. If you look at London, UK silver exports, about 180 million ounces went to India. And of that, about 30% was then transshipped to other Asian countries. So Indian banks and brokers were very astute last year, and they saw an opportunity to buy in London and bring the metal into India. And then as investors and fabricators throughout Asia needed metal, from South Korea to Japan and Taiwan and Indonesia and Malaysia and China, they sold that metal. 30% of the metal that went into India was transshipped. Most of the other stuff seemed to have gone into jewelry and silverware. Another 75 million ounces went into Canada, but most of that actually came into the United States. There were some logistical issues with shipping directly from the UK to the US last year, and dealers who needed silver to meet investment demand here for medallions and small bars found that it was cheaper and easier to ship the silver into Canada and then truck it down into the New York market. So it wasn't that Canada or Canadian investors were buying 75 million ounces. A lot of it went to Switzerland. A lot of it went to Turkey. Turkey has a strong precious metals market. Turkey has a lot of political and economic factors that are causing Turkish investors to buy a lot of gold and silver. And Turkey is the entrepot for metal going, and metal, not just metal, but cars, perfume, and everything else imaginable that is going into Russia, skirting sanctions. It's some of it's coming through a lot of it's coming through Turkey, as well as other countries. So you saw that metal come out of England, and that's the distribution of it all. I want to finish my part of this conversation with a few specific topics, and I've already touched on. First off, gold and silver are hybrid assets. They're financial assets, and they're also commodities. They trade like major currencies in U.S. Treasury securities. People look at gold and silver, and they say, well, these things don't trade the same way that other commodities do. Now, part of that is actually wrong. And we've done a lot of research, and we've shown it in various videos to show that, in fact, many of the ways that gold and silver trade, futures, forwards, options, and physicals, actually are very similar to other commodities. But in some ways, they're different. And you say, well, where do I see that? Where do I see those kinds of trading patterns? And the answer is you see them in major currencies and you see them in US Treasuries. Because gold and silver are quasi-currencies. They're financial assets as well as commodities. Investment demand, as I said earlier, it's the key factor affecting prices. Investment demand is driven by economic, financial, and political developments more than supply and demand fundamentals. Gold and silver are highly secretive markets. That's why a lot of us love them. And this is one of the characteristics that attracts people and entities to this market. It's also one of the characteristics that keeps some institutional investors away from the market. They need a surety, they need due diligence that simply is not available in the precious metals markets. And some of them simply say, I can't touch this because of that. And because of the secretive nature, the markets are open for bad data, for marketing disguised as research, for poor methodology. I'm going to throw investment demand in with my fabrication demand so I can show deficits, or oh, there must be a lot of metal that is somehow or other coming into the market when producers sell forward, but not when fabricators buy or sell forward. So it's kind of like, well, what? Just doesn't add up. And a lot of beliefs. Yeah, when Jay Aaron was sold to Goldman Sachs, the day that they announced that they were going to buy Jay Aaron, I went over and had lunch with Leon Cooperman, who was the head of the Goldman Sachs investment research at the time and was going to be my boss or my boss's boss once the merger was done. And I actually went over to Goldman Sachs that day. And the first thing that Leon said to me was, I don't think of gold and silver as investments. I think of gold as a religion. And I said, I think that you will find that while many people do treat gold and silver as religions, that you can invest in them based on quantitative and qualitative research and do very well. And I think that you'll find some of our quantitative research very interesting. And he said, no, I won't. On that note, let me pass the screen over to Rohit and let him continue the conversation. I'll come back at the end and tell you a little bit more about what we think about the price of silver this year and beyond. Rohit?
Thank you, Jeff. So I'm going to be talking about investment demand, fabrication demand, and supply for the silver market. So let's start here with investment demand. Sorry, we seem to be having some trouble with slides. So investment demand declined sharply last year. You had investment demand fall to about 35.7 million ounces in 2022, which was down from 106.5 million ounces in 2021. This year, we forecast that silver investment demand will more than double from the levels that we saw last year and is expected to rise up to around 84 million ounces on a net basis. So let's talk a little bit about what happened with investment demand last year. So if you think about the investment demand curve in 2022, it had a U shape. In that investment demand was fairly strong in the first quarter of last year. And then you saw investment demand soften over the course of the second and third quarter before again regaining some strength in the fourth quarter. So at the beginning of the year, you had concerns about high inflation and rising inflation. You also had the war breakout between Russia and Ukraine at the end of February. And so both these factors helped to push up silver investment demand, both as an inflation hedge as well as a safe haven asset. These risks, though, even though they continued through the year, their impact started to fade as we moved into the second quarter of the year, and the Fed began its monetary policy tightening. The Fed tightened monetary policy a lot more than what it was projecting it would do, and more than what the market was expecting it would do. So this resulted in bond yields rising sharply, the US dollar rising to multi-year highs. You also had other central banks tightening policy, but they did not tighten at the same pace as the Fed was. And so you saw a much more positive impact on the US dollar as a result of this. And that kind of weighed more on US dollar denominated commodities like silver. So you did have silver investment demand soften over the course of the second and third quarter as a result of these factors. And what you did see was that a lot of shorter term investors were getting out of the silver market. This kind of weighed on investment demand as well as silver prices. That softening in silver prices was used by longer term investors to build up their stock and their inventory in the metal. They were looking beyond the short-term negative impact of tightening monetary policy and were looking beyond to some of the more major and long-lasting economic as well as political issues, which sort of warrant holding silver in your portfolio. So this increase in long-term buying, or rather buying by long-term investors, helped to support both investment demand as well as silver prices during the second and third quarter. And then finally, in the fourth quarter, you started to see a change in market sentiment, where there were growing concerns of a recession. There were expectations that the Fed would slow its monetary policy tightening. And so this sort of helped to bring back some of those shorter term investors who had exited the market over the second and third quarter. And that helped to combine with the longer term investors that were buying silver and push up total silver investment demand during the last quarter of last year. In addition to all of these macro factors that played a very important role in influencing silver investment demand, you also had investors looking at the increased use of silver in green technology and green energy production, especially from the solar panel industry. So this was also another factor that played a role in supporting investment demand last year. Heading into this year, there again are a variety of factors that are expected to be supportive of silver investment demand, and a few that are expected to act as headwinds to silver investment demand. So starting here with the factors that we think would be supportive of investment demand, at the top of that list is a concern of a recession. And tied to that is an expectation of a monetary policy pivot in the second half of this year. So both of these factors have played an important role in driving silver prices and silver investment demand higher over the past several months. And we think that they would continue to provide support to silver investment demand over the remainder of this year as well. Then you have inflation, which has been softening over the past few months, but it's still very high. So for those investors who are looking at the softening of inflation, that kind of bolsters or provides support to the thinking that there would be a monetary policy pivot in the second half of this year. And then you have other investors who are looking at inflation rates right now, which are double the targets set by central bank, or significantly higher than the targets that are being set by central banks for what they'd like to see inflation at. Or when they compare, or when the markets compare current inflation levels to where inflation has been over the past few decades, they still see inflation as being extremely high. And so they are buying silver as a inflation hedge. So both these characteristics of current inflation, that it is softening, but it is still high, are supportive of silver investment demand. Then you have elevated cross-border political tensions. This is a factor that we think is not only supportive of silver investment demand this year, but also in the medium to long term. There's a lot of tensions between a lot of different major economies and regions around the world. This has already begun to weigh on global trade, cross-border investments, and as a result on global economic growth. At some point in the future, the global economy is likely to be in a recession, and then recovering from that recession would be a lot harder given the lack of cooperation and the hostilities between all of these countries. So we do think that this is an important factor in supporting silver investment demand, and that it's a factor that would continue to be supportive over the medium to long term. Then you have the US government debt ceiling debate, which is a current topic. It's something that we think would provide support to both gold and silver investment demand and prices in the short term. But we also think that this is a factor that would provide support to silver investment demand in the medium to long term, even if there is a resolution, which we do expect, to the government debt ceiling debate. And that's primarily because every time the debt ceiling debate comes up, it's handled in an extremely messy fashion. And this does tend to tarnish the reputation of US government debt as a safe haven. And that we think would be something that would be beneficial to other assets such as gold and silver, which are considered safe haven assets. Then you have the failure of the mid-sized regional banks earlier this year, and opinions are mixed about this risk. So some investors look at this risk as an idiosyncratic risk that was limited to those banks, those specific banks. And then there are others who look at those failures as the tip of the iceberg and that there's more to come. So irrespective of who's correct, this risk is an important risk because the banking sector alone can drive the economy into a recession. So problems in the banking sector can drive the economy into a recession. So we think till there is a clearer understanding of this risk, that it would continue to be supportive of silver investment demand. Investors would be paying attention to the labor market, consumer demand, bank lending, and the impact of commercial real estate on the banking sector for clues on how limited or how extensive this risk can get. And then we do think that silver's relative underperformance to gold is something that would be supportive of silver investment demand and prices, especially given all of the numerous macro factors that we think are supportive of silver investment demand. And moving on to factors that we think would be headwinds to silver investment demand. The first is monetary policy would remain restrictive over the remainder of this year. And so that's something that would act as a headwind to silver investment demand and prices. You have tighter financial conditions, in part because of the tighter monetary policy and in part because of these recent bank failures that we saw. And then finally, you have real rates. So if the Fed does hold rates steady as it says it will, and you do see inflation soften over the remainder of the year, that in effect would push up real rates, which could again act as a headwind to silver investment demand and prices this year. So silver prices have risen alongside gold prices. In the past few months, they in fact have outperformed gold prices as well. However, when you look at silver prices compared to gold prices over a slightly more longer term period, you see that they're still lagging behind gold in a big way. And that gold prices have reached record high levels about 10 days ago, and they're hovering around those levels. Meanwhile, silver hasn't really crossed even the highs that it reached in 2020, 2021. And there are multiple reasons for this. This is a pattern that you see often between gold and silver, where in a gold-silver bull market, silver prices typically tend to lag gold in the initial stages of a bull market and then tend to outperform gold in the latter stages of the gold-silver bull market. And there are a variety of reasons for this. So the first is that silver investors oftentimes are a lot more willing to be net sellers of the metal versus gold investors who, when the sentiment is not particularly strong for gold, they generally tend to reduce the amount of gold that they're buying, but very rarely turn net sellers. Because silver investors tend to turn net sellers, there's a lot of silver that gets backed up with in the inventories of market makers or dealers. And then when investment demand or interest in investor interest in silver starts to rise, all of this metal starts coming back into the market and acts as a weight or a headwind to silver prices. And that sort of results in that lag between silver prices rising in the early phases of a gold silver bull market. Then you also have a much smaller group of investors that are looking at silver. Usually, for example, generalist investors will not bother with investing in silver until they see a strong uptrend in gold, which has been sustained for some time. So this again tends to create a bit of a lag in silver prices responding. And then finally, fabrication demand is a lot more important in the silver market than it is in the gold market. And since gold and silver prices often tend to start rising when there's expectations of economic weakness, or we are actually seeing economic weakness, this tends to negatively affect silver fabrication demand, which then tends to weigh on silver prices as well. So for silver prices to start rising, investor buying has to offset not only the losses in silver fabrication demand, but also have to absorb all of the metal that has gone into dealer inventories from previous net selling. So they need to reabsorb all of that. And when all of this metal has been taken in by investors, that's when you start to see a stronger move higher in silver prices. So some of these factors help to explain that lag that you've seen repeatedly between gold and silver over the past several decades. And then silver does tend to outperform gold, and that really has a lot to do with the fact that the silver market is much smaller. So once the momentum does pick up and all the excess metal has been absorbed by investors, it takes very little for silver prices to shoot up strongly. So after 3 consecutive years of net buying, silver ETF holdings declined by a record level in 2022. You saw silver ETF holdings decline by 124.5 million ounces on a net basis last year. And that net reduction essentially reversed about 25% of the net additions over the preceding 3 years. So it's not a substantial decline when you think about it as a record volume of net reductions. The silver ETF holdings are still at fairly high levels. And so far through the first 4 months of this year, you've seen investors turn net buyers of silver again. They've reabsorbed about 8.5 million ounces. And while we don't necessarily see silver ETF holdings to rise in the same way that they did back in 2020, we do think that silver ETF holdings or silver would be net positive this year. Global coin demand stood at around 121 million ounces in 2022, which was off from around 131 million ounces in 2021. If you exclude 2021, the demand in 2022 was the highest since 2014. And demand in 2022 was helped to a large extent by that softness in prices that we saw during the second and third quarters of last year. So coin buyers are typically price-sensitive long-term investors. And so the weakness that we saw in prices during the second and third quarter of last year drew a lot of investment demand from coin and bar buyers during that period. It should also be noted that there was a large secondary market for these coins, and that the figures that you're seeing on this chart are only of the newly minted coins. So it's another thing that happened last year was that you saw another record volume of silver coin sales by the Perth Mint. But despite that, there was some softness in total global coinage, and that really had to do with a reduction in US Mint Silver Eagle coin sales. This year, we expect that coin demand would stand at around 117.6 million ounces, and that relative softness compared to the past couple of years is expected because of the higher price expectation that we have for the current year. So as mentioned before, US Mint silver coin sales were the primary drag on global coin demand last year. US Mint silver eagle coins, the sales of these stood at about 16 million ounces in 2022, which was off around 44% compared with 2021 levels. Now, the decline in sales by the mint to dealers, which was combined with strong investor demand, resulted in a sharp increase in the premia paid by dealers for these coins. So if you look at the chart on the right-hand side, that shows you that sharp increase in a premium that was being paid by dealers to the US Mint, which rose as high as 80% in the third quarter of last year. So with that, we move on to the other source of silver demand, which is fabrication demand. Fabrication demand rose to around 942 million ounces in 2022, which was the second highest level of silver fabrication demand on record. This increase in silver demand was the result of an increase in both jewelry demand as well as demand from the solar panel industry. Both these sources of demand rose to record high levels in 2022. Jewelry demand reached 332 million ounces in 2022, and that increase was entirely driven by an increase in jewelry demand from India. So Indian jewelry demand rose on a net basis by 55 million ounces, taking total jewelry and silverware demand to 107 million ounces last year. Meanwhile, if you looked at total global jewelry demand, that rose by 50 million ounces. So if you exclude India from this, you will see that excluding India, jewelry demand was actually down on a net basis during 2022. So the increase in Indian jewelry demand was really, can be attributed to a variety of factors, but it really was essentially fabricators in India restocking because they had extremely low stocks, and they were facing a economy that was recovering from COVID. There was an easing of COVID-related restrictions, economic conditions were improving, and there was just a whole lot of pent-up demand from 2020 and 2021. In addition to that, they saw a break in silver prices during the second and third quarter and looked at that as a great opportunity to rebuild their stocks, which had been dwindling over the previous 2 years. The increase, if you think about the increase in Indian jewelry demand, which was around 55 million ounces, that roughly equated to the sum of the decline in jewelry demand during 2020 and 2021 when measured from 2019 levels. This year, we think that Indian jewelry demand will normalize and fall back to the historical levels that we saw prior to COVID. When we saw that sharp increase in Indian jewelry demand last year, that was offset to some extent by weakness in Chinese demand because of the zero COVID policy, which put purchases of discretionary items like jewelry on the back burner. And this year, when we see weakness or rather normalization of Indian jewelry demand, we think that reduction in Indian jewelry demand would be offset to some degree by an uptick in Chinese jewelry demand for silver. So the other factor or the other sector that helped to push silver fabrication demand higher during 2022 was the solar panel industry. As mentioned before, demand from this sector rose to a record high, and it stood at 125.5 million ounces during 2022. Strong panel demand largely offset the weakness or the decline or lost demand in silver due to thrifting. There's been a significant push around the world by various governments to develop green energy, This really picked up momentum post 2020 when governments were trying to rebuild their economies from COVID and were using green technology as one of the main engines to drive that growth. Last year, you also saw a renewed interest in moving away from using fossil fuels to generate electricity after the war broke out between Russia and Ukraine. And then finally, solar power is one of the cheapest sources of green energy. And so this clearly helps it to be a front runner in this green energy push that we have been seeing. We expect silver demand from the solar sector to continue rising over the next several years. We expect that new records will be broken over the next several years. What we do think, though, is that the pace of growth is likely to slow compared to what we saw in the past couple of years. So, which is not something that should be surprising, considering that we are seeing growth from much higher levels. So the percentage growth is smaller. Then you have electronics demand, which is an important source of silver demand, which declined in 2022 and was responsible for offsetting some of the strength that we saw in the jewelry sector and in the solar panel sector. So so electronics demand basically declined about 1.8% last year, had fallen to 225.5 million ounces. And most of that decline in electronics demand can be attributed to reduced demand for consumer electronics, as well as to some extent reduced demand from businesses. So there was a reduction in demand for these products from both consumers and businesses because of the high and rising inflation that we had last year, concerns about slowing growth. But most importantly, you saw weakness in demand from consumers because a lot of demand from 2022 was brought forward into 2020 and 2021 when you had a lot of work from home and school from home and the resultant increase in demand for consumer electronics in those 2 years. Silver demand from the auto sector rose last year, but it wasn't sufficient to offset the weakness in demand resulting from weaker consumer electronics demand. So auto production did rise in 2021, but total auto production was still lower than levels seen in 2019. A factor that did help silver demand from this sector was the growing market share of EVs. EVs accounted for around 13% of global passenger vehicle sales in 2022, and this market share is expected to continue rising and continue being supportive of silver fabrication demand from the electronics sector. In 2023, silver demand from the electronics sector is expected to continue softening, but at a slower pace than we saw in 2022. Silver demand from the photography sector, which has been in a long-term declining trend, continued to decline in 2022, as did demand from brazing alloys. And so both of these, the shrinkage of demand in both of these sectors also further offset any strength that we saw from jewelry as well as solar panels. This year, global silver jewelry, global silver fabrication demand is forecast to reach 906.9 million ounces, which is down roughly 4% from last year. Much of that weakness is got to do with that normalization in Indian jewelry demand. There's also slower growth expected in the solar panel industry and an ongoing decline in the photography and electronics sector. So collectively, all of these factors are expected to weigh on silver fabrication demand this year, but the main reason for the nearly 4% decline is really the normalization of Indian jewelry demand this year. So with that, we move on to supply. Total supply, which is made up of mine production and scrap supply, stood at 978 million ounces in 2022 and was down from 983.4 million ounces in 2021. The primary reason for the decline last year was a softening in mine production, with scrap supply really remaining flat year on year. So global mine supply has been in a declining trend since 2016. More recently, we've seen weakness in silver mine supply, which can be attributed to COVID-related disruptions. But even before COVID, you were seeing a decline in silver mine supply, which had to do with the closure or suspension of some major mines. And the main reason for that weakness is because there has not been sufficient new silver mine capacity that has been brought on stream to offset any of these suspensions or closures, suspensions which could be related to issues related with the government or closures because mines had aged. So there just has not been sufficient new capacity to offset this sort of a lost output on the mine supply side. So mine supply stood at 743 million ounces in 2022, which was down about 1% from 2021 levels. And mine supply as of last year was still lower than where it was prior to COVID. The primary drag on silver mine supply during 2022 was reduced output from Peru. Peruvian mine supply declined by around 15.4 million ounces, taking total Peruvian silver mine supply to 92.4 million ounces. This was the largest net decline in Peruvian silver mine supply, excluding 2020, when due to COVID, you saw a 26 million ounce decline. The 92.4 million ounce silver mine production in Peru in 2022 was the lowest it has been since 2001, when Peruvian mine supply stood at 83 million ounces. The decline in Peruvian mine supply last year was fairly broad-based, but a majority of that 15.4 million ounce decline can be attributed to 4 major operations that were closed during the year, at least for the entire period or a portion of the year. So you had 2 mines at Buenaventura, Pan American Silver's Morococha mine, and a BHP Billiton's Antamina mine, which all contributed to that substantial decline in Peruvian mine supply last year. On the side that showed some improvements in mine supply, the largest net increase came from Mexico, where output rose on a net basis by 5.4 million ounces and took Mexican silver mine supply to 193 million ounces last year. The primary driver of an increase in silver mine supply during 2022 in Mexico was the ramp up of MAG Silver's and Fresnillo's CPM mine. The Cerro Los Gatos mine produced a record 10.3 million ounces of silver last year. And Silvercrest Las Tripas mine began production last year as well. So all of these collectively helped to push Mexican silver mine production higher during 2022. There were some offsets. For example, you did have a decline in silver mine production at the San Julian mine as well as the Penasquito mine. So also recently, there were new regulations announced with regard to the Mexican mining sector. This is something that we think would add to the costs as well as increase the burden of doing business in Mexico in the future. It would create a headwind. These new regulations would create headwinds to Mexican silver mine supply, but we do not expect those to have any immediate impact, but more of a medium to long-term impact on Mexican silver mine supply. So global mine production is expected to rise to around 751 million ounces in 2023, and that increase again is expected to primarily be driven by Mexican silver mine production during 2023. Moving on then to scrap supply. This source of supply was essentially flat during 2022, with weakness in jewelry scrap supply being offset by strength in industrial scrap. So industrial scrap rose because of improved methods and increased regulations tied to recovery of metals from electronics. And there was also a substantial volume of silver that was coming in from the ethylene oxide catalyst, where you have seen a substantial increase in demand over the past few years. Now you're seeing some of those catalysts that came in over the past few years coming back into the scrap supply side, in the form of replacement demand for the silver that is used in these catalysts. So scrap supply last year stood at 230.5 million ounces, which, while flat from 2021 levels, was still high by historic standards. This year, we expect that scrap supply would rise to around 240 million ounces, and that increase is primarily being driven by an increase in jewelry scrap. So you have a combination of slowing economic conditions, a possible recession in the second half of this year, and an uptick in silver prices, all of which together we think can contribute to an increase in jewelry scrap. If scrap supply does in fact rise by 240 million ounces this year, that would be the highest level of scrap recovery of silver since 2012. So total supply is forecast to rise to around 991 million ounces in 2023, which would be the highest level of total supply since 2016, when it was a little over 1 billion ounces. The primary driver, again, as mentioned before, for an increase in total supply this year would be scrap supply, but mine supply will also be expected to rise a little bit, unlike last year where it was declining. So new silver mine capacity remained in the downtrend that it has been since 2014. The weakness over the past decade that we've been seeing in new capacity being added to the silver mining sector really has to do a lot with reduced investment in the sector, but this is beginning to change. The higher metal prices that we've been seeing since 2019 has started to bring investors back to the sector. These investors are still fairly cautious with regards to making investments, not only in silver mining, but across the mining sector. And that really ties in with the experience that they had in the 2000s when metals prices rose. The investments that they made basically had poor returns because of the sharp decline in metals prices during the last decade. So investors are returning to the market. They are being more cautious. The upside to this is that a lot of the projects that have been coming on stream in recent years and are expected to come on stream in the future are higher quality projects, and so are expected to have better cost profiles and be better and more efficient mines than the ones that were bought on stream in the last upcycle in metals prices. So while we do expect, we've already seen some new primary mines being bought on stream. So you had the Juanicipio mine, the Las Chispas mine, and the Cerro Los Gatos mine that were bought on stream in the last few years. So it's not like there has not been new primary silver mine capacity being added in recent years. It's just not been sufficient to offset the losses in silver mine supply that were caused by large mines like the Escobal mine, which was suspended in 2017, or the Cannington or Fresnillo mine, which have been seeing silver mine supply decline on a fairly consistent basis over the past few years. Production weighted cash costs continued to rise last year. This was the second consecutive year that cash costs rose. They stood at a record $10.40 an ounce, which is around 26% higher than where they were in 2021. And if you exclude 2020, cash costs have been rising strongly since 2019. So costs were rising in 2019 primarily because of a decline in grades, lower primary silver output, and a general increase in silver prices that year. Now, many of those conditions that existed in 2019 were also present in 2021 as well as 2022, where in 2021 you had the additional challenge of COVID-related disruptions, which pushed costs up. And then in 2022, you had the entire mining industry struggling, not necessarily with mining-specific costs, but just a general inflation, the broader inflation across the global economy, which had a negative bearing on costs. The most important factor influencing cash costs, though, has been stronger silver prices. So stronger silver prices typically tend to push cash costs higher, and that's because mining companies tend to focus their attention on mining lower grade ores. They do that to maximize the life as well as the return on their mine. In doing that, because they're mining lower grade ores, their costs tend to go up, but they can afford to let those costs go up because the higher price of the metal tends to compensate them for it. As you can see in this chart, mining companies are still earning healthy margins despite the rise in costs. Last year's record silver cost did put downward pressure on margins, but those margins last year were still higher than what we saw in 70% of the years over the past two decades. So despite those record high costs, you do see these mining companies are still earning pretty healthy margins, and this helps to explain why they tend to divert their attention towards lower grade ores at times when prices are higher. So with that, I'll just pass this back to Jeff to speak about our outlook for the silver market.
Thank you, Rohit. Just a little bit to wrap up, talk about our silver outlook. Rohit has gone through supply and demand factors and talked to you about what our expectations are in terms of mine production, secondary supply, fabrication demand, and investment demand. And given that, we are projecting an increase once more in investment demand. And that's in terms of the price, perhaps the most important. And we're doing that for a couple of reasons. One is that we saw last year a pause in the investment demand for silver. And our expectation is that there are any number of investors who see it as being an attractive investment for all of the reasons that Rohit was just talking about. In addition to that, the economic and financial and political environments, both globally and in major nations, we believe will remain problematic, and that will stimulate investment demand. And people look at us askance when we talk about this because we say how we think that silver prices will rise more significantly in the near future, 2024, maybe as early as the fourth quarter of 2023. 2024, 2025 has been our target for some number of years, though, for this. And we talk about growing more hostile economic and political environment, and people look at us askance because, let's be honest, we have a very hostile economic and political environment now. But the reality is that there are pockets of strength and optimism and positive economic activity. We've seen interest rates go from 0 to 5%, and it hasn't thrown the world or the United States into a recession. We have lower GDP, but the GDP is still positive. We're facing a number of debt problems, both on the federal level, on state and local government levels, in terms of personal consumers and businesses, private businesses, and it's a global issue. So there are these problems out there, and we do think that we might be heading to a period of more severe economic and political problems. And that may occur as early as the end of this year, but in our view, perhaps more likely 2024, 2025. In that environment, we think that investment demand will rise to about 84 million ounces this year. There's a lot of metal out there to meet that demand, so we don't see a sharp increase. We're looking for the price to average around a little bit more than $24 this year, and possibly rise much more sharply in 2024, 2025. When we talk about this more hostile economic and political environment, no one knows the future. And the political environment, both domestically within the United States, the UK, Europe, Russia, China, India, and other parts of the world, is extremely treacherous right now. We are looking at political movements in many of these countries that we haven't seen since the 1930s. And that didn't end well. So we have to be careful how things go. When we look at the economic environment, we are expecting a recession. We are expecting interest rates to stay high and higher than a lot of people expect for a longer period of time. I believe that the interest rate market is readjusting to a more normal or more historically typical interest rate structure than the zero interest rates that we've basically seen for most of the time from 2009 until this year, last year. We do think that inflation will be problematic. There are some structural and some secular inflationary pressures that are going to remain. There are some political pressures that are there. When we look at GDP, overall economic activity, and inflation, we look at monetary policy, but we pay much more attention to events in the real economy. What's really happening on the supply side of goods and services across the economy? What's really happening in terms of the demand for goods and services from businesses and individuals? And we look at fiscal policy, which has been extremely stimulative for decades now, but has gotten into this hyper stimulative area starting in 2020. And those issues are more problematic in our mind than monetary policy, interest rate policy, or money supply issues. But there do seem to be storm clouds on the horizon. I will say this. I was watching something a couple of weeks ago, and they were saying this guy that they were interviewing, he predicted the economic crisis in 2008. And I laughed. I said, yeah, he did in 1991. I mean, in 1991, this particular individual started pontificating about the state of the economy and how it was going to drive gold and silver prices higher. And he predicted a very severe recession and a financial crisis. He also predicted that it would lead to the death of the dollar and a collapse of the treasury market, none of which actually happened in 2008. But he predicted it in 1991 when he started in his business. And he predicted it again in 92 and 93 and 94 and every year. And when he predicted it in 2007 for 2008, he was right. Like that old clock that, you know, is broken, but it's right twice a day. So when you try to decide what you think is going to happen in the world, and you're listening to people and taking their advice, think about what they've said over the course of their advice giving career. I showed you our track record earlier. It's pretty good. It's pretty good because we tend to be moderate. We're those guys in the middle of the market. You know, we're not the radical left, we're not the radical right politically or economically, and we tend to take a more moderate approach. When people talk about this is the end, say the end of what? Because this isn't a book, it's not a movie, it's not a TV series, it's life. Yeah, we have a lot of economic problems. They could get worse over the next couple of years. We have a lot of political problems that could get worse over the next couple of years. In that kind of environment, silver prices and gold prices could rise very sharply. But it's not the end of the world. And typically, we spring back from that. Sometimes the situation is much worse. World War II, World War I, the Napoleonic Wars, the Great Depression. The depressions that occurred in 1870s, 1880s, and 1890s. I was thinking today, this morning, for some reason, about the toilet paper shortage that occurred in early 2020 during the pandemic. and how people were so freaked out about that. And I was thinking about that in the context of my parents who grew up in the Depression and World War II. And both of my parents lost their fathers in 1928. So they went into the Depression with single widow mothers. And they went through the Depression and they went through World War II. And they saved stuff and they stockpiled stuff and they had cans of vegetables in the basement. And they always made sure that they had a lot of stuff. And then I was thinking about my great-grandparents and ancestors and my great-great-grandparents. And they lived through the 1870s, 1880s, 1890s, when we had periods of very high inflation that make any inflation that you've seen in the 20th century and 21st century pale. And 3 big depressions and recession, and in periods of super high inflation with no safety net, no social security, no unemployment. People died. And my grandparents had, and their generation knew you saved those rusty nails and you stockpiled toilet paper. Not saying that we're going to go that way, but sometimes the ability to manage problems, whether deep recessions or high inflation or political unrest globally or nationally, sometimes the abilities of governments to handle those problems fail. And when that happens, gold and silver rise even more sharply than they do in other times of crises. But they always come back. So bear that in mind when you think about your gold and silver investments. We've given you a lot of information. Quite frankly, you should buy this book. It's the cost of about 6 ounces of silver, 6 silver coins or medallions. And you buy this book and then you study it, and then you have a much more informed view of the silver market: supply, demand, investment demand, inventories, futures and options, trading volumes, how the metal trades going around the world. And that'll help you avoid listening to all those other guys who tell you that, there's no silver left in the world, we're going to run out of silver, the silver price is going to $100 and staying there. We can give you rational, fact-based, real research, quantitative and qualitative, for the price of 6 ounces of silver. We'll be back on July 25th with our Platinum Group Metals Yearbook. You can go to our store, cpmgroup.com/store. You can order the CPM Group Silver Yearbook. It's available today. Gold Yearbook came out in March. You can pre-order the Platinum Yearbook. You can find all kinds of other services that CPM Group offers, including our retail investment program. I'm going to open it up for questions now. Let's see where we are and what time. We have been talking for 1 hour and 24 minutes. And as I said, we have 70 some odd, 69 questions that we had delivered to us earlier. I do not see questions here coming in during the call. If you want to ask a question, go to the, whatever they call that, and you'll find a place that says questions. You can type in a question. Unfortunately, we don't have the capacity set up to answer for you to ask the questions orally. But I will ask Carlos to keep monitoring that and help me out as needed about this. Of the 70 some odd questions, one of the first questions and well, there's a lot of duplicates. And first off, I can handle a bunch of them and say, a lot of them were like, where do you think the price of silver is going to be at the end of the year? And what do you think the price of silver is going to be now, an average this year and go forward? And do you think the price of silver could get $50 or $40 or $100 yet this year? The price of silver can spike sharply, and it will. Our expectation is that it will spike sharply. We don't expect that to occur in 2023. We wouldn't be surprised if it occurs in 2024 or 2025. As I said, we've been projecting it. And we think that the annual average price in that spike, in the year in which prices do spike, will be close to, if not higher than, the annual average price in 2011, 2012, which are the record prices. They're around $36 an ounce, if I remember correctly. Don't necessarily see that happening this year, but predicting the future is very dangerous. And it's particularly dangerous when you have so many extreme issues and extreme politicians and extreme participants in the global economy, as we do right now. Our expectation is that the price will probably stay below $30 for this year. It will be moving higher toward the end of the year, and we do expect higher prices in 2024 and 25, but not necessarily right now. One of the other questions that we had several questions about were the role of solar power in silver, and Rohit already addressed that. There are people out there who are distributing the view that, you know, within 10 years or 15 years, solar power will use so much silver, there will be no other newly refined silver available for any other use. That's not really our projection. We do have projections for silver use in solar panels going out 10 years and possibly even longer. And our expectation is, as Rohit said, that the price will continue to rise, or the demand for silver in solar panels will continue to rise and rise significantly. If it's 124 million ounces or so last year, it might be 140 or 180, 180 million ounces a decade from now. But one of the other issues that you have to pay attention to is that solar panels reach the end of a useful life, and then they get taken off, they get replaced, and the silver in them gets recovered. So as the solar panel industry and solar power industry continues to expand and matures, you'll start seeing a reflow of silver from there, the same way that you saw in photography, although in photography it was much more compressed. And one of the things that we've seen in solar panel industry is that the panels have had a useful life longer than a lot of them, than initially expected by the manufacturers in the industry. You know, so solar panels are around for 20 years, sometimes 25 years. We're waiting to see when the first generation of solar panels really start flowing into the recycling process. Photography, in contrast, a lot of the silver that was used in paper and film and processing chemicals, liquids, was recycled within a year. So when photography started moving to digital, people were afraid that you were losing 240 million ounces of annual photographic use of silver, and you were, but you were also losing about 150, 180 million ounces of recycled silver. So the demand for silver in the photographic industry was much shorter loop between the time you used the silver making those products and the time you you recycled the material. There are some questions about platinum and palladium, which we will address with the Platinum Yearbook. Let's stay on silver here now. There's one question which is about Russian palladium bars, and whether or not it's difficult to liquidate them because of sanctions. And from what I know, the answer is no, because the Russian metal is out there. There are various questions about silver mining stocks. We do not address those things A lot of mining companies are our clients, as you could see from our list of sponsors. And we're not equity analysts. We do study those markets and mining companies as part of our commodities research, but we don't necessarily move it. There were questions about silver numismatic coins being good investments for silver. And numismatic coins are great investments, I think, as numismatic investments. I'm not a numismatist. I know some. I have some in my family. But if you want to invest in silver, you should invest in silver bullion coins rather than numismatic coins. We've talked about mining production. We've talked about Mexico. Rohit pointed out that, yeah, there are issues there. Trying to see what else we have here. How does silver fare in inflation, deflation, and stagflation? Inflation tends to help stimulate investment demand for silver. People see it as an inflation hedge, and it tends to be good. Deflation, silver tends to do well. And that's because in a deflationary environment, the value of virtually everything is declining. And there's a tremendous amount of economic uncertainty that's generated. And gold and silver, investors buy gold and silver in reaction to a rise of uncertainty. Financial market uncertainty, is my bank stable? Is the banking industry stable? Economic, are we going into a recession? Do we have inflation? Political uncertainties. It's uncertainties that stimulate investment demand for gold and silver. And deflation creates a tremendous amount of uncertainty because it's sort of like a black hole economically. And so we haven't had deflation since the 1890s in the United States. I guess we did have some deflation during the Great Depression. And people will say, well, were gold and silver prices rising because and investment demand rising because of deflation or because we were in the Great Depression? You know, and the answer is, who knows? It's an amalgam of economic and political problems and uncertainties that really have helped it. How much silver, physical silver, should I have in my portfolio? That really depends on you and who you are and how much money you have. You know, we've done portfolio simulations, which have shown that over time from like 1970, 1968 until 2021 or so, portfolios that had maybe 20% of their assets in silver as opposed to stocks and bonds have done very well. That's a very high percentage, and I don't know that I would recommend it to most people or any people. But it also depends on who you are and how much wealth you have and what your circumstances are as to how much it is. So it's really nothing that it's nothing that you should try to answer on a generic basis. Okay, I addressed that one. I addressed the gold silver ratio. I addressed predicting these. If I buy a physical backed ETF, is my ultimate counterparty the ETF? And how does a physical, just bear with me, how does a physical backed ETF work? Does it actually buy and sell silver to match the buying and selling of shares? Yeah. If you have shares in a ETF, your counterparty is that ETF company. That ETF company owns the silver, pretty much. There may be some ETFs that have different charters, but by and large, you're not necessarily buying silver through an ETF. You're buying shares in that ETF. The shares are created when authorized participants, major banks and brokers that have trading relations established and trading lines established with the management company that manages the ETF for the ETF company. When they buy or sell large blocks of shares, they pay for them with physical silver. And when they buy back those shares, or when they sell the shares, they pay. When they buy the shares, they pay for it with physical silver, and when they sell them back, they get the silver back. So the changes in the inventories represent these large blocks. If you're an individual investor and you're buying and selling the shares in the market, that doesn't necessarily affect the amount of silver that's held because there's a trading volume and a turnover in those shares. However, most of the major banks and brokers that deal with this will square up, which is why you have fluctuations on a day-to-day basis. They can ostensibly say, okay, I'm taking back all these shares, I should sell them back to the ETF manager and get silver. But more often what they'll do is they'll have a book, a silver book that will include ETF shares, and they will hold some of those shares, depending on how many shares they're buying from investors, and they will hold some of those shares in their own book to meet future demand from investors for shares. And then they will hedge that book, by the way, with futures or forwards or options. Let's see what else. If I have silver in a precious metals IRA, is it potentially vulnerable to federal confiscation? Everything is potentially vulnerable to federal confiscation. It's all highly unlikely. If you have silver in a precious metals IRA, it's really no different in terms of your risk of confiscation than if you have silver in any other type of investment, where you're not holding the physical metal in your own possession. It is extremely unlikely that silver will ever be confiscated by the government. And if you go back to the gold confiscation in 1933, it was the government asked investors were holding gold. And about 25%, maybe 30% of the world's wealth was financial wealth was in physical gold. A lot of gold coins issued by the United States and other governments and such. And the fact that with the deflation and depression going on, you had a lot of investors and say individuals holding their assets in gold. It wasn't a deposit in the bank that could be lent out to help get us out of the depression. It wasn't elsewhere. The government wanted to get some of that money back in circulation to help get us out of the depression. So they said, please turn in your gold. And if I don't remember the exact numbers, but you can go to our website. You can go to our free reads. There's a section there that has free things. And we've talked about this repeatedly and we have slides. The vast majority of the silver that was turned, or gold that was turned in during the recall of gold coins in 1993 was turned in before the decree was actually issued. Franklin Delano Roosevelt was sworn into office, I think it was March 6th. He had declared a bank holiday and closed the bank for a few days. When he reopened it, there were massive lines of people redepositing money, including gold coins, into the banks. That money that they had pulled out during the first 4 years of the Depression because of banking instability and concerns about bank instability and a variety of other issues. And when he came back, everyone knew that he was going to call in the gold coins. He didn't issue that gold coin executive order for a month. It was early April. But between his inauguration And when he actually declared that, like 40 million ounces of the gold was turned in. After he declared it, another 4 million or 6 million were turned in. And investors had the right to hold, each individual could hold 2 gold coins of each year's mintage issued by the United States. And the US had been issuing gold coins for 50 years, 60 years at the time. So you could have 120 ounces of gold that you could keep in US gold coins, 2 for each year. So it wasn't a total call in. The issue is that the government never went after anybody except one fellow who said, hey, come after me. Let's make an example of myself. So they did. The government there, you hear stories about Treasury officials going through bank safety deposit boxes and raiding offices and homes looking at for gold in the safes. None of that occurred. It was actually a voluntary turn-in. The executive order turned it in, but it was not imposed by any physical, let's go out and find people's gold. That was in 1933, when maybe a third of the world's wealth was denominated in gold. They didn't go after the silver. And today, you have less than 1% of the world's financial wealth denominated in gold, and a really small fraction of 1% in silver. So there's absolutely no value or reason for governments to confiscate gold or silver, because it's not the kind of, they're not the kind of assets where people hold on to a lot of their wealth in gold and silver. So there's no economic value for a government to recall the gold or silver. All of which is to say that if you hold silver in an IRA, precious metals IRA, you shouldn't be worrying about federal confiscation. You shouldn't be worrying about federal confiscation of gold and silver anyway. There are a whole lot of other things that are much more worrisome. And if you're worrying about that, you've got to get your eyes tested. If the US falls into a recession in Q4 2023 or Q1 2024, what effect would it have on the silver price? We're not sure. Our expectation, well, here's the thing. If the US fell into a recession, why would it? What are the conditions? Yeah, inflation and recession are these catch-all terms, and there are people who think that like inflation is some beast roaming the street. Inflation is a composite of price changes, and it is affected by all sorts of things. Yeah, a freeze in the banana growing country, floods in the vegetable growing country, interruptions in oil and gas supplies. And recessions are the same way. What is a recession? It's a contraction of economic activity. And the key question for what it means for silver and gold is, why is the economy contracting? Is it contracting because money supply is being pulled out of circulation, which some people seem to think? And yes, money supply is contracting right now because it's been excessive during the pandemic and the post-pandemic period. And the monetary authorities, not only in the United States, but in other countries, are withdrawing some of that accommodation and trying to quell inflation without throwing us into a recession. They may succeed. If it's because of monetary contraction and when we go into a recession, that's less positive for silver and gold. If it's because there are major supply constraints, not supply chain constraints, but actual supply constraints, floods in California because of the massive rains and snowfall limit the planting of a wide range of vegetables and other crops. And you have food shortages and you simply can't buy it. If you have issues with oil and gas supplies because of international political problems or wars, if you can't get semiconductors and so you can't build everything from transistor radios to microwaves to automobiles, and so the supply of manufactured goods falls, and then inflation falls because you don't need those workers because of that. That would probably be good for silver. So whether or not a recession is good for silver depends on what is causing the recession and how the governments respond to it. If you look at past recessions, the price of silver rose sharply in the recession of 1973-74. The price of silver rose very sharply leading up to the recession of 1980. The price of silver was flat to lower leading up to the shallow recession we saw in 1991. You had very high interest rates at that time. And the price of silver was very flat and did not respond to the recession, shallow recession of 2001. But the price of silver started rising in 2004, 2005, and the recession didn't hit until late 2007. So there were other factors that were fueling investment demand for silver, including the expectations that, hey, the economy was overheating and things were really bad, and the Fed was raising interest rates. And you also had, if I remember correctly, a major war in the United States had two major wars, one in Iraq and one in Afghanistan, which was draining a lot of resources from the domestic economy and a lot of other things. So it really depends on where you're, what causes the recession. But again, recessions are those uncertainties. Let's see, this is some, I'm not quite sure what that one is. Let's see if we have any questions. Oh, we do have questions here. Let me see if I can expand this. You suggest higher silver inventories at the beginning of the gold silver bull run, but aren't inventories already tight? How much investors selling and less fabrication demand do you envision to keep the price lower in 2023? I don't think inventories are particularly tight for silver bullion. Inventories are tight for silver coins, official coins, silver medallions, and some small silver bars. But in terms of 1,000-ounce bars, I don't think that the inventories are particularly tight. There are silver promoters who have talked about how the Comex inventories have plunged to around 31 million ounces. And they keep saying that, well, in the next active month, you're going to see that go down even further, sharply further, and it's going to get to 20 million ounces. But the deliveries that you see, and understand that when you take a delivery of a Comex futures contract, what you're taking delivery of is the depository receipt. And it's your decision as to whether to move that silver physically out of that vault to use it or to hold it someplace else. Comex inventories around 31 million ounces are down sharply from where they were during the peak during the pandemic and economic lockdown, and they are back down to normal levels. So in terms of actually registered Comex inventories, they have fallen sharply back to normal levels, and they're not particularly problematic. In terms of eligible but unregistered Comex inventories, they have declined somewhat, but they are still at much higher levels than they were at any time prior to, say, 2018 or 2019. We actually had a chart at the very beginning there. Let me see if I can find it quickly. Come on. I'm sorry that this doesn't want to move. There you go. You can see Comex inventories on the eligible level are still higher than they were at any point prior to 2018, 2019. And this only goes back to 2004 or 2003, but you can take this all the way back to the 70s. And actually in the 90s, I guess maybe you had higher inventories. But that was a completely different silver market. London inventories, yes, they have come down from where they were in that period, 2018 to 2021. But at 850 million ounces, that's still a lot. Shanghai inventories are relatively high. And then a lot of this metal has actually moved into other markets. So it's not particularly problematic in our view. what you're seeing there. And we're not quite sure how much fabrication demand will decline in the next recession. And we don't necessarily see tight inventories causing the price of silver to rise. See if we have other questions there. No. I'm going to get one gone. And see if I have anything else here. Silver price forecast, silver medical applications. Which types of financial institutions, bank, credit unions, et cetera, trade and sell silver? There are a handful of banks that trade silver and sell silver around the world. One of the trends that we've seen across the banking industry over the last 30 years is A, a contraction of the number of banks, and B, a increased specialization. So people will look at the silver bullion trading banks in the United States, and we're down to a couple because a lot of other banks have gotten out of that business because it's a specialist business and it has a lot of esoteric or idiosyncratic aspects in terms of dealing with physical assets as opposed to financial paper assets. In Canada, you probably have about 4 or 5 banks that trade, buy, and sell silver. In London, you probably have half a dozen or a dozen. In India, you have more than that. And in China, you have more than that. And in Malaysia, you have more than that. So banks will do it. I don't know that credit unions get involved in gold and silver. I'm not sure that they can. I'm not sure what the regulations are. One of the issues across the financial markets is non-bank financial institutions. And people will, like, for example, criticize the getting rid of the Glass-Steagall laws in the 1990s. And the Glass-Steagall laws were actually redundant and meaningless to the broader financial markets when they were repealed. When it was repealed, because the rise of non-bank financial institutions that were allowed to do banking-like services, taking deposits, paying interest on deposits, giving you checking accounts, demand deposits, CDs, non-banking financial institutions had been given a lot of permission to do a lot of banking services. And the banks were actually suffering. They were at a loss because they were regulated. And the non-banking financial institutions were not regulated. So you had Morgan Stanley, Goldman Sachs, Bear Stearns, Lehman Brothers, non-bank financial institutions taking on a lot of banking things, actually squeezing the banks. And the banks couldn't compete because of Glass-Steagall limitations on their activity. So when Glass-Steagall was repealed, it was repealed because it wasn't really helpful to the economy. And in fact, it was somewhat detrimental because banking regulators could audit and oversee and investigate banks, but they couldn't touch those other banks, non-bank financial institutions. All of which is by way of saying there are non-bank financial institutions that will buy and sell silver. And back prior to 2008, 2009, I think the laws may have changed. You had insurance companies that had affiliated subsidiaries or wholly owned affiliate companies that were buying and selling. And if you go and look specifically at gold and silver, within the banking industry in the United States, if you're a bank and you're taking in deposits, you have a reserve requirements for US dollar deposits. I think it's 10% or 12% right now. But if you take in gold and silver deposits, the Office of Controller of the Currency says you have to have reserves that are prudent. You have to have a prudent amount of reserves of your gold and silver. And your discretion as to how you define prudent. And most of the banks that we've known, we have seen them have a 8 to 12 to 14% reserve requirement. So actually in line with what they're doing with currencies. Non-banking facilities didn't have that prudence requirement. And we know one company that has suffered financial problems, enormous financial problems in 2008 that used a multiple of 40. They had what, 2.5% reserve requirement? And we've known traders who have said, I was working at this bank and it was bought by a non-bank financial institution or a non-US bank that had different regulations, and the leverage they wanted me to trade at was such that I just wouldn't do it. And so I'm looking for a new job. So it's banks, brokerage houses, non-bank financial institutions, insurance companies may still be doing it. I'm not quite sure. I think we've run for 2 hours now, almost all but 3 minutes. And we're starting to see people gear up and head to lunch. So I think that I'm going to say thank you for listening in. We hope that our information was useful and that it's information and insights and analysis and data that you can take and you can use to invest more from a more informed basis, have more rational expectations for supply, demand, and prices. And if you're a producer or a refiner or a fabricator or somebody else who has a financial exposure towards silver that is not an investment exposure, that we have given you information that helps you manage your exposure to silver and silver prices and silver price volatility better than before we started 2 hours ago. We'll be back in July with Platinum Group metals. We'll still be doing our videos twice a week, more or less, interrupted by holidays and such. And we're available at info@cpmgroup.com. I've given you a list of sponsors, media partners, and distributors. Please look into those companies, see if they have business services they can provide you. We will be participating in some other things going on. This video will be posted on YouTube when it's processed. It might take a day or two, probably by later today. In the meantime, take care of yourself, take care of those around you, and see if you can help us make this a better world. Goodbye.